evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for January 8th, 2019. And we're talking a pure form of trading. What happens next is clearly within the plan. We're not going to predict it, but we are going to trade it, and it's called the departure trade. It's the departure from our target, which is achieved, into 2575. In a prior video, this is the S&P futures. We discussed this dead cat bounce, or this little rally up in a bear market swing. How far will it go? The first target was the 20-day exponential, and at the time that was roughly 2550. And if above that, we have our dawn spot, the gravity spot, into 2575. Both targets were achieved. There was a little hiccup on the way, a deeper pullback than expected. We thought the market may have peaked at this point, but we did get our full target, not just of 2050, which was the 20-day simple moving average, but it's also the gravity spot. So we are above these targets. That was a little bit of a surprise that we got this full target and did not fall shy of it as we thought maybe last week. So now we keep the same logic, still not predicting, but are planning. Let's talk about this. The market is into a spot, into a marker, into a level, and there's a couple more above it. Just if we get a little bit of a drift to the upside, we're looking at 2600 to be another peak point if we drift up to this level. And if the market can break above these spots, our next gravity point exists at 2626. So that's going to be our plan. Keep in mind, if we zoom in here, that 2626 gravity spot, if we look closely, is going to intersect the 50-day exponential average. So that is the, I guess maybe at this point, the alternate thesis or bullish outcome, which is an upward drift, continued short squeeze, continued breakout up towards 2600 and then 2626. However, the other way to see this is as a, again, dead cat bounce or expired feline recoil, whatever you want to call it. It's an ABC to the upside, is a counter trend swing on our expected, planned, and now achieved snapback or the rubber band rally. Big downswing, and then once we get so pulled away from our average, that was a video from last week discussing how we get a snap back to the 20. That's multiple examples of this concept. A push away from the 20 and a rally into it. A push away from it, a rally into it. And if the 20 fails to hold, we often do get a movement to the 50-day exponential. Well, that again is the upside potential pathway. However, we look at our volume, especially bullish volume, on the way up, and we see a pretty clear negative divergence. So that tilts the scale, tilts it from the 50% level, which is a random chance, to a downside resolution, because the market is rallying on lower and lower or less and less bullish volume. And we're not in holiday mode. Holiday mode's behind us. This is our first full trading week of 2019, and we have a few holidays in January, but nonetheless, the holidays are over. So this volume divergence should not be happening right now. It is a caution sign that says the probable pathway may take us back to the low. Now, we do not want to get too far ahead of ourselves, and we don't think it'll look just like this. Maybe it swings down a little bit, retraces, goes sideways, and even goes further in the future to the downside. But nonetheless, that is what we will be looking for the dominant thesis or the expected plan for a downside edge. Now, how do you trade this? Multiple ways to do so. If the market does keep extending, if you want to be a little bit more conservative, you might wait for a break. And a trendline break methodology is more conservative because it waits for the market to do something. For example, if we draw a pure trend line or a more adaptive trend line that's closer to the market, we would wait for the market to break beneath it. So that would be roughly the 2550 level, or maybe even beneath that for a conservative entry. The aggressive entry would be on the touch rule. So once a market is now, as of today's session, touching our 2575, maybe if it touches 2600, but right now 2575, that is a trigger to get short or to sell call premium, or to do in-out spreads of puts to the downside, to play however you wish to a bearish pathway, at least to 2,500. That would be simple. 2,550, that's probably a decent midway target or a minimum target. And if you really want to press the odds, press the bet, press the edge, taking us down to 24 and 2350. We'll also update our plan from these technology stocks, because that was the initial video, was a snapback rally toward the 20-day exponential average. That has been achieved in all of the stocks we mentioned, especially technology names, but also the XLK itself. So the same level, same logic, same strategy takes place. Given that the market has bounced up, again, multiple examples, into our 20 and the 50-day moving average, or the daily chart levels, either we come back down and retest the lows, as was the case these times, or, not seen on this chart, we go ahead and break through them. So right now, keep focused on 62.50 for the XLK. If we get a bullish break, a short squeeze, that takes us to 65 per share. That's the alternate thesis short squeezed pathway, and we can see that happening, 2 examples, in the prior months. However, a bearish outcome takes us from about 62, you can wait to trigger short, at about 61.80, breaking this session's low. Also looking here to play for 60 or as low as under 58 per share. You can go into trade grids and play out your strategies to these levels. Again, be careful. Netflix does have earnings. If you're playing Netflix and other names, just watch the earnings grids. Microsoft has rallied back toward, and just a little bit above, the 20-day exponential with its volume divergence. So keep focus on these. The last video updated us from a move or a snapback rubber band toward this 20. Given that those are achieved, any profits are being taken, and the next play or strategy or short-term method is to play against this level. That can still be done on the intraday frame, playing bearishly on departures or flags or other bearish positions that take place on the downside. Facebook is a good example of achieving the 50-day exponential. So it's already here. It was there in December and then fell away from it. Again, not a prediction, but given the past and the downtrend, maybe Facebook shares fall from this level. And if they do, there are multiple strategies to trade a bearish departure swing. And the same would be true in Amazon, but it's a little bit higher than maybe expected. But then again, so were these swings against the downtrend. Apple has been weaker, and it's not even at the 20-day exponential target. That's because of fundamental reasons, China reasons, supply reasons, and otherwise lower guidance. So Apple does have a more bearish tilt, and that is a stock-specific risk. Now, Netflix is different. It is testing its 320 level, which is the falling trend line as drawn, and well above not just the 50-day exponential, but the 300 per share mark. So this is a cautionary tale if you are going short into resistance, because if that happens, take your stop if needed, or otherwise adjust or roll positions if short or if sold premium above key levels, because markets can extend rapidly, quickly, and on higher volume, and that would trick and trap a lot of traders, and that will result in financial losses unless you have a well thought out, well planned option sell position. Nonetheless, this is a cautionary tale in case the markets do go ahead and break powerfully through resistance. But until then, we're going to keep watching this 2575, and if above that 2600 level, for a possible bear swing away from our pivots. This is Corey Rosenblum for the Theo Nightly video for January 8th, 2019. Take care.